Welcome to the FinGlimpse podcast, where we analyze the world of business, finance, and the economy. We cover the latest market news, economic trends, and some interesting businesses. As a standard disclaimer, this podcast is for informational purposes only and should not be considered investment advice. Always do your own research. Now, let's get started.
Okay, let's unpack this. We're diving deep today into a really interesting investment research report. It focuses on a major Indian industrial player, Grasim Industries Ltd.
That's right. The source here is a pretty detailed report from Morgan Stanley. It's dated June 9, 2025. And they really put Grissam's different businesses under the microscope, looking at, where the future potential might lie.
And our mission for this deep dive, well, we want to pull out the absolute key insights, the big opportunities this report is highlighting. Why exactly is Grasim being called a top pick here? What factors are expected to, drive value?
Yeah, think of it as cutting through the financial jargon. We want to find those surprising details and the really essential bits of information for you.
Exactly, because the report makes it clear this isn't just about one thing. There are, as they say, multiple strands to the story here.
We need to understand how all these different parts, the established ones, the brand new ventures, how they're all expected to contribute to growth and ultimately the company's value.
Get ready, because some of these connections might genuinely surprise you. So, first things first. The report is pretty bullish, right? Morgan Stanley has an overweight rating, calls it a top pick, and that price target, RS3 and 500.
Yeah, that implies, well, at the time the report was written, around a 36% upside from where the stock was trading. So yes, quite positive.
Okay, 36%. And that confidence, it stems from what? 4 main opportunities?
Exactly. They've identified 4 core drivers that underpin this positive view.
Yeah.
These are the big themes playing out.
The first one is the next phase of value unlocking in their paints business. That's relatively new for Grasim, isn't it?
It is, and apparently it's already doing better than expected. That's a key point.
Okay. Then number 2.
Ultratech Cement, or UTCEM. It's seen as this really strong, consistent earnings compounder for Grasim.
Right. And third?
The rapid scaling up of their new age businesses, so think B2B e-commerce renewables, maybe smaller now, but growing very quickly.
Interesting. And the last one, number 4.
This one's a bit different. It's about a potential sustained reduction in the historical holding company discount that Grasim's stock often trades at. Basically, the market perception changing.
Got it. Okay, 4 pillars. Paints, cement, new age businesses, and the holdco discount. Let's dig into each one, starting with paints. So paints, the recent launch, and you said the report seems impressed, like positively surprised.
That's the term they use, yeah. Over the past year, since they launched, Grasim seems to have really exceeded what analysts were expecting on the execution front. Things like activating capacity, building the supply chain, expanding the dealer network across India.
How extensive is that network getting? Are we talking national scale already?
Pretty much. They've achieved a pan-India presence remarkably quickly. The report mentions, as of the end of fiscal 25, 137 depots and a presence in over 6,600 towns.
Wow, 6,600 towns. That's building out fast.
It really is. A massive physical footprint established in a short time.
Okay, building depots is one thing, but are they actually selling paint, gaining traction?
Yes. The report definitely points to market share gains. They've got a full range of products, something like 176 products, nearly 1,250 Cs.
That's a lot of paint options.
It is. And they exited fiscal year 2025 with around 4% market share in the organized sector. Now, 4% might not sound huge, but the key thing is the exit run rate that was already in the high single digits.
High single digits run rate already?
Right.
For a new player, that's moving. What's working for them? How are they doing it?
The report points to a few factors. Strong brand pull, apparently. Building that large distribution network is key, and importantly, they're leveraging Ultratech Cement's existing network, which is smart.
Ah, synergy there.
Exactly. Plus, developing a network of painters using customer discounts, dealer incentives, the whole toolkit to encourage trial and adoption.
Is this working everywhere and equally, or are there regional differences?
Well, initially seems penetration has been a bit easier in smaller cities, tiers 3 and below. About 3/4 of their dealers are there. But strategically, the company is really focusing on the premium end of the market. That was over 65% of their revenue share towards the end of F25. That focus is important for managing margins, the difference between mass market and premium paints.
Right. So looking ahead, what does the report expect for paints?
Fiscal year 2026 is seen as pretty crucial. That's when 6 of their plants are expected to be fully operational.
6 plants coming online.
Yeah. The report's base case sees them becoming a strong number 3 player in the organized market by fiscal year 2028. They're estimating about 9.5% market share by then.
Okay, number 3. But isn't Grasim themselves aiming higher? I thought I read something about number 2.
Their aspiration is definitely number 2, longer term. The report's F28 base case revenue target is around 77 billion rupees. That's actually a bit more conservative than the company's own guidance, which is 100 billion.
Still, 77 billion is a huge number from a standing start.
Oh, absolutely. Massive scale up.
What about profitability? When does this start making money?
Well, costs are expected to stay pretty high for a bit. All that expansion, marketing spend, it adds up when you're trying to grab market share.
Makes sense.
So the report's base case projects EBITDA break-even by fiscal year 2029. The company's guidance is a bit more optimistic, aiming for F2028.
Okay, break even around F28 or F29. How does all this impressive execution feed into Grasim's overall valuation in the report?
This is where it gets really impactful. The report significantly boosts its valuation for the paints business within their sum of the parts model, the SOTP.
Okay.
They now estimate paints contributes about Rs 360 per share to Grasim's value.
360. Wow, what was it before?
It was Rs 150 per share previously. So that's more than doubled. It directly reflects this better than expected execution they've seen so far.
And how do they arrive at that 360 number? What's the methodology?
It's based on their projected revenue for paints in fiscal year 2028. They then benchmark that against listed competitors like Asian Paints, Burger Paints, using valuation multiples. But they apply a discount 25% in the base case to account for the fact that Grasim's profitability will likely be lower initially compared to those established players.
Got it. So benchmarked against peers, but with a discount for lower near-term profitability. That paints story really does sound like a major catalyst.
It definitely has a whole new dimension to Grasim's value proposition.
Okay, so opportunity number 1, paints. Let's shift gears to number 2. The cement powerhouse, Ultratech Cement, UTCEM. The report calls it the best play in their cement coverage.
Yeah, it's a real cornerstone for Grasim. I mean, UTCM is already India's largest cement player, right? And the report sees its earnings compounding story continuing strongly. It's a crucial part of Grasim's overall value.
And they've been very active, adding capacity, boosting market share.
Extremely active. Aggressively so, you could say. Their capacity market share jumped from around 20% in fiscal 22 to about 28% by the end of fiscal 25.
That's a big jump. How do they manage that?
It's a mix. Significant organic growth, adding about 44 million tons themselves, but also major inorganic moves, acquiring around 26 million tons through deals for Grasim and ICM.
And the report mentioned a strategic angle to these acquisitions, particularly focusing on the South.
Exactly. Historically, UTCEM's share in the southern region was lower, maybe around 11% in F24. So these acquisitions and their own expansions are heavily targeted at boosting their presence there. The aim is to get to roughly 24% share in the South.
So filling geographic gaps, consolidating leadership, makes sense.
Precisely.
With all this new capacity coming online, what about actual volume growth and the prices they're getting, the realizations?
The report expects UTCEM's volume growth to beat the industry average pretty comfortably. They're projecting a 10% compound annual growth rate CAGR over the next 3 years. The industry overall is expected around 7.5%.
Okay, faster growth. And realizations?
Their realizations, yeah, the average price per ton, have actually been outperforming the pan-India trends.
Why is that? What gives them that edge?
Well, the report suggests it's down to a few things. Their huge national footprint allows them to play regional price variations better. They're increasing the share of premium products in their mix, more direct sales channels, and they keep expanding their retail outlets, that UBS network they have.
Right, the UBS network. And it's not just standard gray cement, is it? There are ancillary businesses too.
Correct. And those are scaling up nicely as well, contributing to the overall earnings picture. You've got ready-mix concrete, RMC, that's about 8% revenue. White cement is around 3%. Building products, roughly 1%. They all add up.
Okay. But a major theme for UTCEM in the report seems to be cost optimization.
Oh, absolutely. This is a huge lever for their earnings growth.
Yeah.
UTCMM has a very ambitious target here. They want to achieve about Rs 300 per ton in cost improvement by fiscal 27, compared to where they were in F24.
300 rupees per ton, that's substantial. Have they made progress?
They have. They already achieved Rs 86 per ton of that target in fiscal 25.
Okay, so they're on their way. How are they planning to get the rest? What are the levers?
The report breaks it down. Improving the clinker conversion ratio, basically using raw materials more efficiently. A really big one is increasing the share of green power.
Green power. How?
Two main ways. WHRS waste heat recovery systems, capturing heat from their own plants and renewables. Green power is just significantly cheaper than traditional sources.
Makes sense. What kind of share are they targeting?
Their share was already around 33% at the end of F25. They're targeting 60% by F27. And get this, 85% by 2030.
85%. That's a massive shift. Huge cost savings potential there.
Absolutely huge. And there's more. They're also increasing the use of alternative fuels, targeting 15% share by F27. Those are roughly 25–30% cheaper than conventional fuels.
Okay. Any other cost levers?
Yeah, logistics. They're focused on reducing primary lead distances, basically.
Right.
How far cement travels initially from the plant. They're targeting about a 60-kilometer reduction by F27. That saves money. And finally, just pure operating leverage. As volumes grow strongly, those fixed costs get spread over more tons.
So it's a multi-pronged approach to efficiency. Dominant player, getting bigger, getting leaner. How does this all add up for Grasim's value?
Well, the report expects UTCEM's consolidated EBITDA, that's earnings before interest, taxes, depreciation, and amortization, to basically double over the next 3 years.
Double, wow.
Yeah, and the balance sheet looks strong too. Net debt to EBITDA was around 1.2 times in F25. They might even become net cash positive by F28, assuming no more massive expansions. And in Grasim's SOTP valuation, UTCEM is the heavyweight. It contributes something like 68% of the total estimated value.
68%. Okay, so you've got the exciting news story in paints and this incredibly solid, optimizing giant in cement. Quite a combination.
Definitely.
Okay, that brings us neatly to opportunity number 3, these new age growth engines. The report notes that Grasim's traditional core businesses, viscose staple fiber, VSF, chemicals, they're expected to grow, but maybe more steadily, nominally, partly because they're already running near full capacity.
Right, and near-term demand might be a bit lukewarm. So while those core businesses provide stability, they might not be the source of explosive growth right now. That's where these newer ventures step in. They offer faster growth and what the report calls valuation optionality.
Okay, makes sense. Optionality. So the first one mentioned is the B2B e-commerce platform, Burla Pivot. Tell us about that.
Yeah, launched back in 2022, it's basically a digital platform for construction materials end-to-end, and it's scaling up incredibly fast. Revenues were annualizing at around 50 billion rupees as of the end of F25.
50 billion annual run rate in just 2 years or so. That's really fast.
It is genuinely explosive growth, and management's target is even higher, around 85 billion rupees, which is roughly $1 billion in annual revenues by fiscal year 2027.
$1 billion by F27. Okay, but margins must be thin at this stage.
Yeah, it's currently a low-margin business, which you'd expect for a platform focused on scaling up so quickly. The target is to reach cash break-even by 2030.
Okay, path to break-even by 2030. How does the report actually value this high-growth, low-margin venture in its model?
They've introduced a value for Burla Pivot in the SOTP, about Rs68 per share.
Okay, how do they get there?
They basically benchmark it. They look at recent funding rounds and market valuations for similar companies in the B2B construction materials, base names like Inframarket, Off Business. They use price-to-revenues multiples. The base case applies a 1.4x multiple to Burla Pivot's projected revenue.
Got it. Based on peer comparisons using revenue multiples. And the other new age business is renewables. Aditya Birla Renewables.
That's right. It's a wholly owned subsidiary. Initially, its main role was supporting the decarbonization goals of the wider DTR Birla Group. But it's scaling fast, going beyond just internal needs.
How fast is it scaling?
Capacity grew from about 550 megawatts in fiscal 22 to around 1.5 gigawatts by the end of F25.
1.5 gigawatts, that's significant scale.
It is. And the plan is to keep adding capacity about half a gigawatt, 0.5 GW, every year going forward. So the report sees this increasing scale and the earnings it generates as another distinct source of value for Grasim.
Okay. And how is this renewables business valued in the SOTP?
The report assigns it a value of Rs44 per share.
44 per share, valuation basis.
They use target enterprise value to EBITDA multiples. Their base case uses a 10x multiple. They do note this is slightly lower than the multiples for some pure-play utilities companies they cover, maybe reflecting potentially lower margins compared to, say, large utility-scale power generation.
Right. So even though these new ventures are maybe earlier stage, lower margin for now, analysts are clearly seeing them as important growth drivers, adding that optionality to the overall Grasim picture.
Exactly. They diversify the growth story beyond the traditional core and cement.
Okay, that leads us to the fourth key opportunity. This one's a bit different. It's about the market's perception of Grasim itself, the idea of the holding company discount moderating.
Yes, and this is actually a really critical point for unlocking value for shareholders. Historically, Grasim stock often traded at a pretty hefty discount compared to the value of all its underlying assets,
Why was that?
largely because the market saw it mainly as just a holding company for its stakes in listed subsidiaries like Ultratech, Aditya Birla Capital, etc. And they're also concerned sometimes about capital allocation decisions, like the investments made in Vodafone Idea, for example. The average discount was hovering around 50% between roughly 2018 and 2023.
50% discount. That's huge. But the report suggests this has started to change.
It really has. Over the last couple of years, that discount has narrowed quite significantly. It's averaged closer to 30% over the past 3 years.
Okay, from 50 down to 30, what's driving that change?
The report attributes it to a few things coming together. Firstly, the big strategic investment in the paints business. That signals a clear focus on internal growth, not just holding stakes. Secondly, expansion in their other core segments. Thirdly, the emergence of these new age businesses, which also demonstrates internal growth drivers and maybe reduces perceived risks of capital misallocation.
Mm-hmm.
And crucially, the market is starting to see the initial value unlock from the paints launch and its strong execution. People are realizing there's more to Grasim than just its holdings.
So what's the expectation going forward? Will this discount narrow further?
The report thinks so. They expect it to narrow a bit more and then stabilize at these lower levels. Their base case now actually assumes a 30% discount going forward. That's down from the 40% they used previously.
Okay, baking in that lower discount now.
Yeah. The thinking is, as the paints business really scales up and becomes a more significant part of Grasim's own value, and as the market increasingly focuses on Grasim's operating businesses, the perception continues to shift away from it being just a passive holding company.
And what if paints does even better than the report's already positive base case?
Well, the report suggests that could potentially squeeze the discount even further, maybe down to 25% in their bull case scenario. So this narrowing discount, it's almost like finding hidden value for shareholders. It magnifies the impact of the growth in the underlying businesses.
It really sounds like the market's view might finally be catching up with the reality of Grasim operating multiple growth engines internally.
That seems to be the argument, yes.
Okay, so pulling all these threads together, paints, cement, new age, the whole code discount, how did the report actually arrive at that RS 3,500 price target? And maybe more interestingly, what does the current market price imply about what the market values today?
Right. So the price target, and they also provide bull and bear case scenarios, it's all built using a probability-weighted sum of the parts methodology, SOTP.
Okay, SOTP, break that down for us.
Basically, they value each distinct piece of the business separately. So the standalone businesses, that's the traditional core like VSF and chemicals, excluding paints and B2B. Then they value the paints business itself. Then the B2B e-commerce, Birla Pivot. Then the renewables business.
Right.
And then they add the market value of Grasim's stakes in all its listed subsidiaries, Ultratech, AB Capital, AB Fashion, Hindalco, even Vodafone Idea. Crucially, they then apply that holding company discount, that 30% in the base case, only to the value derived from those listed subsidiary stakes, not to Grasim's own operating businesses like paints or chemicals.
Ah, okay. So the discount only applies to the holding company part of the value. And what did you say the current market price suggests?
Well, the report made an interesting observation. Based on the market price around RS 2,574 back in early June, and if you assume that 30% holding company discount is fair,
Yeah.
it implies the market is currently assigning very little, maybe even close to zero, value specifically to the paints business within Grasim's overall share price.
Zero value for paints, despite the strong start.
Or, alternatively, it could mean the market is still factoring in a higher holding company discount than the report's 30% base case. Either way, the report's view is that there's a disconnect. They believe as paints continues to execute and scale, the market will start assigning a clear, positive value to it. And that should help narrow the discount further and push the stock price towards their target.
That's a fascinating point, a potential mispricing or lag in perception regarding the paint's value. Okay, but no investment cases without risks. What are the main potential downsides the report highlights?
They're quite clear on the risks, which is good. On the downside, the paint's business execution could slow down, maybe hit roadblocks despite the strong start. You could see prolonged weakness in those core cellulose or chemicals markets. The new age businesses, like B2B, might fail to scale up as quickly or profitably as hoped.
Okay, what else?
Weak demand or maybe tougher competition could impact Ultratech Cement's performance despite its strengths. And yes, they still mention the risk of potential poor capital allocation to subsidiaries as something to watch.
Right, the classic holdco risk. And on the flip side, what could make things even better than their base case scenario? Upside risks.
Upside risks include an even stronger, faster ramp-up of the paints business than they currently model. Cement prices could be higher than expected, which would obviously benefit UTCEM, or you could see a stronger recovery in prices for VSF or caustic soda, boosting the core businesses.
Okay. So, a range of potential outcomes, but the central thesis is positive based on these internal drivers and the changing perception.
That's the gist of it, yes.
So, to kind of wrap up this deep dive,
hmm
this Morgan Stanley report really paints a picture of Grasim as being much more than just, an umbrella company for its listed subsidiaries.
Absolutely. That's the core message, I think. It highlights these multiple strong internal growth engines that are now firing
Yeah.
and distinct opportunities for unlocking value.
Yeah, you've got the surprisingly successful launch in paints. You've got the consistent optimizing performance of Ultratech Cement, and then the rapid scaling potential of these newer ventures like B2B e-commerce and renewables.
Exactly. And the report argues quite strongly that all these factors together support the potential for both a re-rating of the stock, meaning the market views it more favorably, maybe applies a lower discount, and also continued earnings compounding potential over the next few years.
So hopefully, for you listening, this deep dive has helped give you a clearer, maybe more granular understanding of all the different facets of Grasim's business today and the specific catalysts analysts are watching so closely.
Yeah, it's definitely a complex company, lots of moving parts, but hopefully understanding these key strands, paints, cement, new age, discount, helps cut through some of that complexity.
Absolutely. And maybe just one final thought for you to consider on your own. Think about this. You've got these really ambitious, large-scale new ventures like paints and B2B e-commerce launching and growing rapidly. At the same time, you have ongoing cost optimization and strategic shifts happening in the massive traditional areas like cement.
hmm
How might the interplay between these new parts and the old parts of Grasim's business fundamentally reshape the company's overall identity, its narrative, and maybe even its risk profile over the next, say, decade? Something interesting to mull over.
That's all for this episode of the FinGlimpse podcast. If you found our discussion insightful, please consider subscribing and leaving a review. We'd love to hear your thoughts and suggestions for future topics. Until next time, stay informed and make smart decisions. Goodbye.